management supervision refers to the process of overseeing and managing a collection of financial assets in order to achieve specific financial goals. This involves carefully selecting and analyzing different investments, monitoring their performance, and making adjustments as needed to ensure that the portfolio is well diversified and meets the desired risk and return objective. The supervision aspect involves continuous monitoring of the portfolio to ensure it remains aligned with the overall investment strategy and risk tolerance of the investor. Overall, financing portfolio management supervision is a complex and ongoing process that requires careful planning, analysis, and monitoring to achieve the desired financial objective. This is a detailed examination of a bank's loans, investment, and other financial instruments to evaluate its risk management practices and identify potential weaknesses in the asset portfolio. It involves analyzing the bank's loan portfolio, credit policies, risk management systems, and loan underwriting practices. This assessment is important as it provides insight into the bank's financial health and helps identify areas for improvement.
So next one is target review. Target review is an evaluation of analysis of specific aspects or components of a portfolio. It involves examining particular securities, investment strategies, or risk factors within the portfolio to assess their performance, risk, and alignment with the investor's objective. The purpose of a targeted review is financing portfolio management is to gain a deeper understanding of the selected element within the portfolio and make informed decisions based on the findings. It helps portfolio managers or financial advisors identify areas of strength or weakness, potential risks or opportunities, and areas for improvement or adjustment. For example, security level review. This involves analyzing individual securities or financial instruments within the portfolio, such as stocks, bonds, or derivatives. The review may focus on evaluating the fundamentals of specific companies, assessing the creditworthiness of bond issuers, or analyzing the performance and prospects of particular stocks. So next one is process review. Process review is an evaluation of the procedures, methodologies, and workflows involved in the managing a portfolio of financial assets. It involves examining the processes and practices followed by portfolio managers or investment professionals to ensure efficiency, effectiveness, and adherence to the best practice. The purpose of process review in financing portfolio management is to assess the robustness and reliability of the portfolio management processes, identify areas for improvement, and enhance overall portfolio management capabilities. It focuses on evaluating the structure, documentation, controls, and decision-making frameworks that guide the management of the portfolio. For instance, trade execution and settlement, assessing the efficiency and accuracy of trade execution and settlement processes. This includes reviewing the system and controls in place to ensure timely and accurate execution of trades, proper allocation of assets, and settlement of transactions.
Follow-up evaluation on management commitments for financing portfolio management is a critical process that helps ensure accountability and trust in the organization. This evaluation assesses how well the management team upholds their promises and aligns their actions with the best interests of stakeholders. Firstly, consistency and follow-through. This aspect of the evaluation focuses on the management team's track record in honoring commitments and delivering on promises. It examines whether the management consistently follows through their stated goals, targets, and strategies. Key points to consider during this evaluation include historical performance, adherence to plans, and accountability. Next is clarity and transparency. This aspect of the evaluation assesses the quality of the commitments made by the management team. Evaluators analyze whether these commitments meet the criteria of being specific, measurable, achievable, relevant, and time-bound. Lastly is alignment with stakeholders' interests. This aspect of the evaluation focuses on how well the management's commitments align with the interests of various stakeholders including shareholders, employees, customers, and the broader community. Key points to consider during this evaluation include shareholder value, employee welfare, customer satisfaction, community impact, and ethical practices. Overall, follow-up evaluation on management commitments for financing portfolio management is essential for ensuring transparency, accountability, and effective decision-making within the organization. It helps build trust among stakeholders and enables the management team to refine their strategies for the best possible outcomes. Security in financing is a fundamental aspect of the financial industry, serving as a protective mechanism for all stakeholders involved in financial transactions. Whether it's an individual seeking a personal loan, a company raising capital through debt issuance, or an investor considering various financial instruments, security measures play a crucial role in ensuring the smooth functioning of the financial system. Here are the importance of security in financing. Firstly, security provides a means to mitigate the risk associated with lending or investing capital. When borrowers offer collateral or asset as security for a loan, it serves as a guarantee for the lender that if the borrower defaults on the loan, the lender can seize and sell the collateral to recover their funds. Similarly, when investors purchase secured financial instrument, they have a claim on specific assets of the issuing entity, reducing the risk of default. These risk mitigation aspects ensure that lenders and investors have a higher level of confidence in their financial transaction, making financing more accessible and cost-effective. Next, having security in place can enhance a borrower's abilities to access financing and secure larger loan amounts. By offering collateral, borrowers reduce the lender risk and demonstrate their commitment to repaying the loan. This increased confidence allows borrowers to negotiate better terms, lower interest rates, and access higher loan amounts than they might have without providing security. For businesses and individuals alike, the availability of secured financing opens up new possibilities for growth and investment. Other than that, security expands the range of financing options available to borrowers. Secured loans such as home mortgages or car loans typically offer lower interest rate compared to unsecured loans because of the reduced risk for lenders. Additionally, secured financing allows borrowers with limited credit history or lower credit score to access loans that might otherwise be unavailable to them. Having various financing options empower individuals and businesses to choose the most suitable and cost-effective solutions for their specific needs. In conclusion, security in financing is a critical component of the financial system, offering risk mitigation, increased borrowing capacity, access to diverse financing options, and market confidence. It promotes responsible borrowing and lending practices, protects vulnerable borrowers, and facilitates sustainable long-term planning. The presence of security measures fosters trust and stability in the financial sector, benefiting individuals, businesses, and the overall economy.
Next, the classification of financing. I classify it into three types. The first one is internal versus external financing. It distinguishes between financing obtained from internal sources within a company and financing obtained from external sources. Internal financing refers to funds generated from within the company using its resources and operations. It does not involve external parties or the need to incur debt. Common internal financing sources include retained earnings, profits reinvested into the company, selling surplus assets, or cutting costs to free up cash. Meanwhile, external financing involves obtaining funds from outside sources beyond the company's internal operations. This type of financing often requires entering into financial agreements with external parties. External financing sources can include banks, financial institutions, private investors, venture capital firms, or public offerings of stocks or bonds. The choice between internal and external financing depends on the company's financial situation, growth objective, risk appetite, and availability of external funding options. The second one is debt versus equity financing. Debt financing involves borrowing money from external sources, such as banks, bondholders, or other lenders. Debt does not dilute ownership or control of the company. Lenders have no claim to ownership rights. However, failure to repay debt obligations may result in legal action and damage the company's credit worthiness. Meanwhile, equity financing involves raising funds by selling the company's ownership stakes, equity, to investors. Investors become shareholders with ownership rights and a claim to a portion of the company's profits. Equity financing does not require regular repayments like debt. Instead, investors share in the company's success or failure. Dilution of ownership may occur if the company sells significant equity stakes. The choice between debt and equity financing depends on factors like the company's financial health, capital structure, risk tolerance, and the preference of existing stakeholders. The last one is short-term versus long-term financing. It distinguishes financing based on time duration of the funding. Short-term financing provides funds for a relatively brief period, typically up to 1 year. It is used to address immediate cash flow needs and fulfill short-term operational requirements. Common forms of short-term financing include bank overdraft, trade credits, and short-term loans. Meanwhile, long-term financing provides funds for an extended period, often exceeding 1 year. It is used for capital investment, major projects, and financing fixed assets. Long-term financing options include long-term bank loans, bonds, and equity financing. The choice between short-term and long-term financing depends on the purpose of the funding, the duration of the project or investment, and the company's ability to service long-term debt obligations. Next, moving on to the test of suitable security. Test of suitable security refers to the evaluation process used to determine if a particular security is suitable for an investor or an investment portfolio. It involves assessing various factors to ensure the security aligns with the investor's objective, risk tolerance, time horizon, and other relevant considerations. Investors can make informed decisions and build a well-suited investment portfolio by considering those factors. The test of suitable security helps investors make informed decisions and select appropriate investment for their circumstance. The specific criteria for the test of suitable security can vary depending on the investor's goal and preference. Financial advisors often truly assess each investor's unique situation to recommend suitable securities that fit their financial goals and risk appetite. This personalized approach helps investors achieve their objective while minimizing unnecessary risks or mismatch in their investment strategies.
Next, I will continue to explain the basic step for taking a security. So the first step is to draw a personal financial roadmap. So in order to have a successful investing is by figuring out your goals and risk tolerance. So either on your own or with the help of a financial professional. So before you make any investing decision, take an honest look at your entire financial situation. Step 2 is to evaluate a personal financial capability in taking risks. So all investment involves some degree of risk. So if you intend to purchase securities such as stock, bonds, or mutual funds, it is important that you understand before you invest that you could lose some or all of your money. Step 3 is to consider an appropriate mix of investment. So by investing in more than one asset category, you will reduce the risk of losing money, and if one asset category's returns fall, you will be in a position to counteract your losses in another asset category. Step 4 is to create and maintain an emergency fund. So most smart investors put enough money in savings product to cover an emergency like sudden unemployment. So some make sure that they have up to 6 months of their income in savings so that they will know it will absolutely be there for them when they need it. And the last step is to avoid circumstances that can lead to fraud. So ask questions and check out the answers with an unbiased source before you invest. And always take your time and talk to trusted friends and family members before investing. Moving on to the types and forms of security. So there are 4 main types of security, which are debt security, equity security, derivative security, and hybrid security, which are a combination of debt and equity security. So debt security, or so-called fixed income security, represent the money that is borrowed and must be repaid with a term outlining the amount of the borrowed fund, interest rate, and maturity date. So in other words, debt securities are debt instruments such as bond or a certificate of deposit that can be traded between parties. Next, equity security represent ownership, interest held by shareholders in a company. So in other words, it is an investment in an organization's equity stock to become a shareholder of the organization. Next, derivative security are financial instruments whose value depends on basic variables. So the variables can be assets such as stock, bonds, currencies, interest rates, and market indices. And lastly, we have hybrid security, which is types of security that combines the characteristics of both debts and equity securities. So many banks and organizations turn to hybrid security to borrow money from investors. So the other forms of securities can be charge, means an interest or right which a lender or creditor obtains in an asset. So the asset can be anything like immovable asset or movable asset like car, gold, shares, goods, and etc. Next, we have pledge. So pledge is used in the case when pledgee or a lender has to take actual possession of the asset. So for example, if there is any default by the pledger, then the pledgee has the right to sell the security or goods to recover their due amount. Also, we have hypothecation. So hypothecation is used to create a charge against securities of movable asset like cars or vehicles. So for example, if any default by the borrower, the lender must take possession of the security and after that they can sell the asset. Next, we have lien. So this is the term used for the right to detain the property of another person until any claim is satisfied. Also, we have documentation, which is anything that provides evidence for a transaction. So the person who has performed each action related to a transaction and the authority to perform those activities are all considered within the documentation.